Ladies and gentlemen, welcome back to yet another episode here at the Debate Circle, and we are diving into the Finance Act 2023 now that the bill has been enacted in Parliament, and we'll be discussing some of the interesting changes that you will be seeing as of July moving forward towards the financial year. And I am joined in studio by a very regular guest. At this point, we shall consider him our taxman here at the Debate Circle. I will allow him to introduce himself. Welcome very much.
Yeah, welcome. Thank you so much. John is my name. I'm happy to be back. I think the last time
John who? Who is John?
So, well, my name is John. I would say I'm a Kenyan, a taxpayer, among many other things. But I think for today, I'm just coming here in my capacity as a tax enthusiast. I think I've said that rightly, but yeah, and I'm happy to.
He's being very humble with this introduction, but it's okay. You will discover him as we go. Yeah. But thank you very much for joining us. So we were here, we did the Finance Bill 2023. Lots of conversations around it, mixed reactions. Yeah. Your pay slips have finally felt the heavy punch that comes with the National Housing Levy Fund. But here we are, you know, the Lord is gracious. So just to kick us off, we have finally gotten to an agreement on the key changes for the Finance Act 2023, which took effect as of 1st July. So we did have a bit of a conservatory orders that were temporarily stopping the implementation of the Finance Act. And for some asking, what was the issue that was really being addressed? Because eventually we still had the aftermath of everything we were trying to stop. So what was the necessity that instigated that?
Yeah, thank you. Happy to be back. You're right. The last time we were here, I think my parting shot was participate. And I guess very many people did participate.
It was one of the it's one of the finance bills that has had a very overwhelming amount of participation, if you can quote unquote put it that. I remember asking what exactly is
it's public participation.
Public participation. Yeah. So we can satisfiably say there was a threshold that was met.
Yeah.
Yes.
So yeah, I mean, the last time we were talking here, we were just talking about public participation. I did say that we had some ample time, I remember, to put in our comments. Our comments were put. Some were considered, some not so much, and now we are here. Yeah, our paychecks are the way they are. Fuel did increase. The housing levy did come into being, even though it had some slight changes. Mm-hmm. But just more or less coming back now to your question, I think post the finance now bill. Now becoming the act. Now we've seen quite a number of petitions. I think then probably 9 in total. But I think the one that we know most about is the one by Omtata, and probably the other one by the Law Society of Kenya. The Omtata one is specifically what you're talking about, because that's the one that was very much in the news, and it's the one that led to the conservatory orders that you're talking about. The crux of the petition is that the petitioner, in this case Omutata, feels that the bill and the subsequent act and the provisions inside the act have not met the constitutional test. And I think the one argument he's made through the whole of the petition is that ideally some of those provisions ought to have been passed through the Senate, and they were not. So I guess we saw a lot of hulabaloo with the court stopping, court giving conservatory orders.
This is a lawyer talking about the judicial system in a hulabaloo, but of course, let's continue.
So the High Court gave conservatory orders, and very many people were happy because it sort of gave us some sort of relief,
some sort of hope.
Some sort of hope, maybe. And then we went to the Court of Appeal, and the Court of Appeal had sort of a different opinion, and sort of the Court of Appeal then set aside the conservatory orders. And I think one of their major reasons for doing that is that they said that ultimately the taxpayers were not facing quote-unquote irreparable damage So ideally, because the finance bill is a continuous, it happens every year, whatever harm possibly we will have suffered, if at all this is unconstitutional, can be more or less corrected in the next cycle.
Sounds
Many
like
people disagree, but
it sounds more like, let's see how this goes.
Yeah.
Then we'll think about it.
Think about it, yeah.
Okay. So we're here now, we have the Finance Act. I think I want us to dive into some of the key things that were being addressed.
Yeah.
And of course, I'll start with the creators in the house, Hi, digital creators. So we saw the digital content monetization, which will now be subject to a withholding tax at the rate of 5% for residents and 20% for non-residents, that is without a permanent establishment in Kenya.
Yeah.
So as a creator in this space, can you just walk us through how do you go about filing or even billing for invoices? You've been making your content and probably haven't been factoring in this digital content monetization. So how do I now set up a tax system as a creator in that digital space?
I mean, the first thing that you really need to know is that as TDC, you guys must need to start paying something. But more seriously, you're right. We have a 5% withholding tax and a 20% withholding tax on residents, 5% is on residents. And ideally, we did have a small discussion about this the previous time. I mean, the way withholding tax works is the person who is sort of making payments to you gets to withhold that money and remits it to the revenue authority on your behalf. So that's ideally what should happen now.
But doesn't function as a final tax.
So at least now for the residents, it's not a final tax. So what that means is after the person who is paying you submits the 5% on your behalf, you, as the person who has monetized digital content, aka TDC, needs to sort of then consult.
Should we talk with you, Apple, and you might attend?
Should probably get somebody now. But you sort of then need to go and sort of then file returns, So then you have to account for the other 25% if you are a corporation, or then take your income through the graduated scale. So then you get your tax and then subtract the 5% that had been withheld. For non-residents, it's different because the 20% is assumed to be, it is a final tax, so they don't have to do anything. As long as you withhold, they're more or less good to go.
Okay.
Yeah.
I guess that means there's more work for lawyers as we're moving into this digital content and more taxes. We're expanding the tax base. So yes, we've also introduced withholding tax for sales, promotion, marketing, and advertising services. This is for residents at 5%. So who exactly are we talking about when we say sales, promotion, and marketing? Because someone else is asking, so are we talking banners? Are we talking TV? Like, where exactly are we applying this withholding tax for this category?
Yeah. Then, as you just previously said, this is also a new measure to sort of more or less expand the tax base. And the people more or less we are targeting are people who are doing sales promotion, are doing marketing and advertising. As the Act says, there's no much science to that. Really, it's people who are more or less doing that. You will notice that, in this Finance Act now, there's been a lot of provisions that have come in to more or less expand the tax base. Many people still say that, I guess, more or less the people captured are people in the formal industry. I wonder whether people who do content on TikTok are more or less people in the formal industry. I'm not sure, but...
not entirely, because, some of them still juggle different jobs, but I think to some degree it has captured a much more wider group of people.
True.
Because a lot of people are monetizing off that content. So that now introduces such elements. I don't know if that sector is grown enough for us to say that it will really fill the gap. There's been outcry that we should have allowed the space to at least have some sort of standardization in growing before we can start taxing it. But the government of the day thinks otherwise. That's money we're coming for it.
I mean, but I don't know whether this is a fair or unfair statement to make. I do think, at least based on my observations of this industry, the guys who are more or less on the very high end and the guys who are the low end, guys who make almost nothing and guys who are making a killing.
Yeah, but you see, we can't really. This is some of the questions we were trying to ask from the previous discussion. Is what data is informing some of these amendments? Because we cannot take the assumption of some of the key content creators, because some of them, their creations are out of their own passions and not necessarily projects they've been paid for. And also factoring in that a lot of creators take such a long journey just creating to build a brand before they can finally start making money. But I know there are agencies that represent creators who are paid. So I guess that's ideally what we were trying to tap into. Anyway, we will survive as we move into that.
More or less to your point, actually, I do agree with you. I mean, we don't know what kind of data informed this. Perhaps the incentive here was just to expand the tax bracket, and then whoever is caught is caught. And maybe also to your point, we'll probably never know how much money was raked in from this industry. It would be interesting to know.
It would be interesting to see that sort of data. Allow us to move on to the amendments of taxation for employment income. So these ones I picked from the Kenya Revenue Authority website. So these are some of the three, I picked these three. I found them interesting. So amounts received by an employee as a payment of traveling allowance to perform official duties have been excluded from taxation as gains from employment, where such amounts are based on standard mileage rate approved by the Automobile Association of Kenya. Now, when I read that statement, it sounds very convoluted. So probably you want to break that down. What do we mean by we're finally allowing this traveling allowances to be excluded from taxation?
Okay. So maybe a bit of context, When you're thinking about taxation of employees, the same is regulated under Section 5 of the Income Tax Act. And the idea behind that is, if I'm an employee of whoever employer is, whatever benefits I get from my employer, all those benefits are taxable benefits, whether they are monetary or non-monetary. So there are a whole set of rules under Section 5 that sort of regulate what goes, whether one thing is taxable or not taxable, to what extent it's taxable, to what extent it's not taxable. But specifically for this provision, what we are more or less trying to say is that if my employer sends me out to, say, I don't know, Nanyuki, and I take my personal car, I drive there, if I can use, for example, the AA rates to account for my mileage in terms of fuel, that amount of money is not counted as part of my
benefits
income, as part of my income. And maybe just to give an opposite example would be if I travel, may say, abroad, and my employer gives me, say, $1 million to just like spend and cater, for my stay there. To a certain extent, that amount is taxable. So this is just one of those things that maybe the Revenue Authority, rather the government, has more or less thought.
It's very good that you rectified. I was like, the Revenue Authority has done what? But okay.
I think for most people, there's always this conflation between the tax collector and
it's very important for people to understand that the Kenya Revenue Authority is mandated to collect the taxes. So often you hear people really accuse the authority for some ambiguous things, but it's not how it really works.
But actually, for most of the people, the Revenue Authority and more or less
the government of the day seems to be one and the same thing. So just allow me to also move on to another element in this employment income. So club entrance and subscription fees paid by the employer on behalf of the employee shall be treated as a benefit and taxed on the employee. So the expenditure will be allowed against the employer's income. So does this mean we will consider this as trading entities, or how exactly are we going about this?
So what we are more or less saying here is that if my employer sort of pays for me a club where I can go golf over the weekend, or I have a subscription of some sort, that's more or less a taxable benefit on the employee and deductible expense on the employer side. So what has more or less happened is the tax burden has moved from the employer to the employee. I mean, traditionally, I guess it was always thought that if you have a subscription of some sort, or if you have a membership to a certain club, it's for business. Perhaps we are moving away from that kind of thinking. But really what has happened with this provision is now the tax burden has moved from the employer to now the employee.
That's
so
right.
whatever subscriptions and club subscriptions that your employer has gotten on your behalf are now part of your salary, quote unquote, and you now get to pay
taxes on the same.
Yeah.
Okay, you might reconsider your golfing tendencies moving forward. I think the third part is it clarifies that the market value of a share for purposes of taxation as a benefit shall be when the employee exercises the option as opposed to the date the option is granted.
Yeah.
So just before we go on too far here, so can we highlight some of the key things to note when it comes to your tax obligation if you agree to enroll on an employee share ownership plan? Because they're coming a bit more open, especially I know for a lot of startups, that tends to be the route they go. So what becomes your tax obligation now?
I mean, I think for me this was one of the more interesting provisions. You're right. I mean, most of these kind of arrangements you probably see them with startups where, for example, if I'm employed by a startup, they'll say we'll give you, say, I don't know, $1 million per month, and then we'll give you 100 shares every month or 100 shares after 5 months, that kind of thing. And as I've previously said, all the benefits that you more or less get from your employer are benefits that are taxable. With this specific provision, we're sort of more or less getting clarity on the value of the shares. At what point do we think about the value of the share? So I guess just to more or less explain it a bit further, is that, I mean, one way of thinking about this is that you could look at the price of the shares as the point when you're entering into that agreement, for example, to receive the shares. Say, every 5 months. So then you'll be saying, okay, as of 1st June when 2018, which was when I was employed, the share was this. But then you see there is some mischief there because 10 years down the line, those shares could be way more.
Yeah.
I mean, or way less. So I think here one of those things that the Act is more or less saying that as when we are thinking about this, we'll look at this from the point of the market value of the shares at the point when those shares are more or less vesting.
Rather than the date that it was provided.
None of the date was provided, yes.
We're really expanding that tax base.
It is one of those things that is. But if you really think about it, it's both good and bad. Because, I mean, you could be getting shares now and startups tank every other time. 10 years down the line, the startup is not there. And dudes are like, yo, the shares were valued at
this particular amount
of money. So it has its blessings and curses. And maybe one other thing to note about this specific provision is that we also, the Act goes on to state at what point they deem vesting to have occurred. And there are about maybe 3 or 4 rules that the Revenue Authority will be looking at. In this case, it is indeed the Revenue Authority that will be looking at them. Yeah.
I think now really need to think critically, especially if you're working for a startup. How much of their shares do you actually want to take the risk for?
But it's not really a bad thing. It's just that now you have to pay tax for it.
True, but then also there's
the
uncertainty of where is this going. But anyway, we have to move in hope, not necessarily thinking as the risks that come. Allow me to move to turnover tax. So we've amended the turnover tax upper threshold from 50 million to 25 million annually. So the Act also increases the rate from 1% to 3%. So this threshold reduction effectively increases the medium enterprises that must pay TOT, because the reduction from 50 to 25 will capture a lot of businesses in there. So should we say this is a good move for expanding the tax base? Because the idea was we wanted to see a bit more enterprises grow before we start taxing them out, because we've not only increased the rate, but we've also reduced the threshold. I'm thinking, is this really a good move, or it's more of let's see how this goes?
So you're right. So the maximum. So if you earn a turnover of 50, initially the turnover threshold was 50 million, it's now 25, which now means, I guess there were so many entities which were making, whose turnover was say between 25 to 50 million that are now locked out.
Yeah.
And then now on the other hand, we've increased the turnover tax from the 1%
to 3%.
To the 3%. I think for me, the one thing that one needs to take note of when it comes to turnover tax is that it's an opt-in sort of system. Yes. So as long as you meet the criteria, that is, your turnover tax is below 25 million, you can then opt into the system if you think the system works better for you. So just for clarity, one should ask the question, what is the other option? The other option is if you're a company, or if you're a company incorporated under the Companies Act, you pay you pay tax at 30% or at 7.5% if you are, say, a branch or a foreign entity. Yeah? So I think ultimately a commercial view has to be taken on this, in my view, and one has to sit back and think, okay, is it better to pay 3% of my 25 million, or is it better to just pay 30% post expenses? Because you see now with the turnover tax, you do 3% of your total turnover, but gross, you don't subtract any expenses that you have incurred.
We're
talking about
your
gross. So if you're running a supermarket and you've sold 100 loaves of bread of say 100 million each, that doesn't make sense, but like 2.5 million each, not 2.5, let's say you've sold 10, well, I don't know that I'm making my point, but if you've sold, if your revenues from the sales if your sales are say 26 million, 25 million, let's just say 25 million, you pay tax 3% of the 25 million. You don't subtract the cost you spent on buying the goods that you're selling, yeah?
Yes.
Versus on a 30% basis that where you've more or less subtracted your expenses, your rent, all those other things. So I think at the end of the day, one should be able to take
a
commercial view,
and
know what is better for you, what is not better for you.
Okay.
And then decide to opt in or to opt out.
Okay, that makes sense. I think just to move on, we had talked about the digital assets, and now we're introducing a tax on the income that's derived from the transfer or exchange of this digital assets.
Yeah.
We're talking cryptocurrencies, NFTs, at a rate of 3%.
Yeah.
So what would be the tax obligations for whoever is remitting for the platform or the person facilitating the exchange of that digital asset?
Yeah.
So now there is an obligation to the platforms or the people per se that are facilitating this exchange. What's their tax obligation now, especially to the ones that are residents here?
Yeah.
Yes.
So it's a good point you make, yeah? So for this specific tax, the burden the duty to remit falls on the person who is sort of facilitating the transfer of the digital asset, yeah? Essentially, in a context of the crypto assets and all other cryptocurrencies and assets that I know of, I mean, it would be the platform, yeah? And this specific provision sort of says that in the instance that you are an non-resident, what you have to do is that you have to get somebody here in Kenya to be more or less your tax agent and be accounting and remitting the taxes to the revenue authority on your behalf. For the residents, they also have more or less to do the same thing, to more or less remit the revenue, rather the tax, not the revenue, the tax on the revenue that is gained from exchanging those digital assets, which is quite an interesting provision, because I think this is one of those things where the burden is then being put on the person who is facilitating the transfer. Which, when you really think about other taxes that are on assets, for example, your typical capital gain, for example, stamp duty, which is also maybe say payable on the transfer of assets, usually the duties fall on either of the parties who are more or less, the duties fall on the transaction parties, yeah? Here, more or less, what you're saying is the duty is now falling on the
person that's facilitating the transfer.
Yeah, facilitating the transfer. It would be very interesting, I mean, to see how this ultimately will be applied, more or less, especially to non-residents, because then again, when you think about the people who run, I don't even know who runs some of those websites.
That's where we were going about, because It sounds enthusiastic, but if you've been in the circles for decentralized finance, I don't know how that's going to happen.
I mean, it's not really unheard of. It's difficult, but it's not unheard of. And I guess what the act here is targeting are people who are more or less trading on the goodwill. So when you think about when we began taxing, say, or imposing taxes on, say, Netflix, and and one of the questions was like, okay, who is going to go get Netflix? I don't even know where Netflix is incorporated.
But you see, for them to operate here, there's some sense of a business entity that's been registered and things of that nature. People are trading in cryptocurrencies where they ideally you don't even have a customer care number.
That's true. To call.
If anything goes south, it's gone south. It's you south, and your coins. So anyway, as you've said, it's not unheard of, but it will be very difficult.
It's going to be very difficult.
I don't think it's necessarily a bad move in terms of how we're thinking of expanding the tax base. I think there's just a lot of room to learn in terms of how we're going to build that framework and just how to mitigate the loopholes, because there are a couple of existing loopholes, but I will not sell your secrets out there. So
but maybe another way to think about this is probably there'll be a lot of reliance on the goodwill of people who run those platforms, and perhaps maybe also when you also think about it, this is probably one of those taxes that are just coming in and will also serve us better as the world progresses, as rules on beneficial ownership, as rules on disclosure, as tax havens get more or less closed up. Maybe then we'll begin to see the people behind the actual entities, and then we'll be like, okay, you owe us X amount, give it to us.
At first, I didn't think it was necessarily bad, because I think we are eventually going to get to a stage of some form of decentralized finance. And starting early allows us to build a framework that is good. And also, I think if we can talk about the taxation of it, then that means implementation, and us now even declaring some of these coins as legal tenders can soon become a reality. Because if we are able to tax it, then why not declare them as legal tender? I think it's a good move. It's starting backwards, going forwards. But let's see how that goes, because for the longest it's been declare this a legal tender, declare this a legal tender. So let's just see how that space moves. I know for a fact there's a long-term thinking behind this.
And maybe also one last point to add before we move on. When you really think about how we've been doing a lot of tax laws in this country, more or less the policy usually is, okay, let's put a tax first. So we know this amount is taxable, then we'll figure out how to collect it later. And there are quite a number of taxes that have been legislated and regulated that way. So perhaps in future we'll probably see some sort of guidelines, some sort of subsidiary legislation, some sort of policy statement that says, okay, if you are XYZ, then this is how we'll get to you. But I think there's a lot of that in our tax legislation.
That's our style of coming up with some of this.
It's part of our style.
Now, allow me to move forward. And I know this one is especially for businesses that are registered for VAT, and e-Teams has been everywhere. Carry websites, e-Teams, a lot of marketing on the same. So the Kenya Revenue Authority is enforcing compliance with its electronic tax invoicing system, ideally what I'm referring to as e-Teams. So all VAT registered taxpayers must comply with the relevant regulations. So how does this change affect the taxpayer, as the Act disallows for supporting invoices of transactions that are not generated from e-Teams? Yes. So it's just, I think this eventually affects taxpayers. I'm not so sure the how, but that's why you're here.
So, I mean, you are right. I mean, there's been a lot of push towards e-Teams. And when you really think about
actually, wasn't aware it was mandatory. I remember asking you about the same.
We did have a discussion about this.
I think it should have a bit more information on the same. I know we're just talking about e-Teams, but I guess for people who already work in the tax sector, they're conversant with it. But for people who don't work in that world, what are some of the things that you should take note in terms of how this will actually affect the taxpayer?
Yeah, I think one of the things that you've said is more or less mandatory, and this also then has to be applied together with the other VAT regulations that we know of. So ideally, you more or less captured by the 18th regulations if, say, you are eligible to register for VAT, and if you have already registered for VAT, yeah. And I think one of the at least more interesting things, at least for me, is that this is one of those things that will increase transparency, at least in terms of VAT, in terms of how we do VAT, but it will also probably be a pain for very many VAT for very many people who deal with VAT, with taxable supply or vatable goods, yeah. But ultimately, I think...
Why exactly a pain, though?
It is a pain because you more or less have to transition from the current system that you have to a new system.
It's not very complex.
New system, you
the
have to
authority
get machinery.
will assist, and they have the option of using your mobile phone or your laptop for the software. So onboarding is not necessarily as complex. I think it's just when it's a new change, it tends to be uncomfortable at first. But I think in terms of cohesion on VAT and just as you said, transparency, I think moving to an electronic system is better.
It will actually it will boost a lot of it will increase a lot of transparency when it comes to input, output, and I think one of the very more interesting things is that we are more or less saying that moving forward we will not be able to, you'll not be able to rely on an invoice that has not been generated through eTIMS to offset your output VAT unless the same has come from the eTIMS system, which is good, which is a very good move, I think, in my view, because ultimately what this means is that this supplier who has supplied you goods will more or less have an incentive to declare those goods, goods and charge other people VAT. So more or less the cycle will self-correct. But the reason why I say it's painful because all transitions are painful. I mean, when you think about a supermarket, and now you're more or less being told you have to change one system to the other. It's usually very painful. You have to train your staff. You have to more or less onboard software. You have to onboard new equipment, special gadgets to do all these things. And even when you think about so when we did the last shift to the system that we have now, to where now we are going, I mean, the last shift was also kind of very painful. And I think to date, there are still people who have their amounts unreconciled. But ultimately, it is a step in the correct direction.
I think the sooner you do it, the better placed you are.
Perhaps.
This is what the Act stipulates.
It is.
So it's no longer a perhaps question.
It is not a perhaps question. The sooner the better.
The sooner the better.
Yeah, the sooner the better.
Just say goodbye to ETR. It's been a good journey. Either way, Kirago, there's so many elements to this Act that we could discuss. But for now, allow us to just settle on this one. So thank you very much for coming on studio. And of course, if you do have any questions regarding some of the things that we've discussed, we've talked about NFTs, we've talked about digital content creation, monetization. There's lots on turnover tax, a bit on VAT, and also just some of the changes when it comes to benefits on your income, employment, salaries, and things of that nature. So if you do have any questions, feel free to drop them in the comment section and we will get back to you with those questions. Before we close out, what is your parting shot in terms of, do you think this Act will eventually allow us to increase the tax base and hopefully collect more from the Revenue Authority side? Because we are hoping it works. Because if it doesn't, some of us are paying a lot of money when it comes to taxes, but not saying much. Do you think this is a good move in terms of expanding the tax base and even just allowing us to finally collect more? Because the idea is let's collect more so that we stop relying on debt. Do you think this Act is going to propel us towards that direction?
So maybe the Act as a whole, it might be a difficult thing to say the act as a whole is a good thing, yeah? At least there are 9 petitioners who disagree with various aspects of the act itself. But I think we do have some very forward-thinking provisions in the act. Taxing of digital assets. We are probably one of the few countries in the world that has more or less, that are more or less moving towards that direction. Taxing digital, people who are already, people who are monetizing digital content. That's also very forward thinking if you really think about it. And there are a lot of provisions in the act, in the new Finance Act 2023, that are more or less trying to expand the tax base. On the other hand, there are some more controversial, maybe not controversial, but there are some provisions that people feel have been pinching them so much. And there are very many people who are praying for the 9 petitions in court. And specifically the housing levy, I think there are very many people.
We've already validated this payment. Like your pay slips have already chomoed some chums.
I guess people have already gotten used to it.
So you've already gotten used to reducing your budget somewhere in there.
So there are provisions such as those. And I think they are big, for a majority of Kenyans, we're also waiting to hear what the court will think about, at least for me, the housing levy. And I'm also keenly following Omutata's petition to see ultimately what the court thinks. But then ultimately, we just should know that I think for the last 5 years, every finance bill has been subjected to a petition of some sort.
But this one, to be honest, I really need to understand the ambiguity behind the national housing levy. Because it's like that Ponzi scheme that tells you, come with 5 people and then you will make money. I really need to see that transition. Math is not mathing. And then it sounds like one of those things that are just being imposed now. Like there's no really option for you to opt out or in.
I mean, and I think for the housing levy, when you really think about what we saw in the bill versus what ended up in the act, I think in the bill we are talking about 3% that you could recover
what you
in 7
ordered
years.
versus what you got.
Yeah, so ultimately we'll wait to hear what the court says. I'll probably not go as far as to say it's a Ponzi scheme. I don't know whether it's a Ponzi scheme.
No, I did not say it's a Ponzi scheme. I just said how it felt looking at your pay slip. It feels like one of those things. Especially knowing that you will probably not be a beneficiary of this.
I mean, yes. So if you earn above 150,000, you're more or less a contributor, but you more or less can't benefit from the funds.
That's the problem where most people have. How exactly is my contribution? It's what I'm saying. It's like come with the 5 people, and then you make money. It's like if I'm not a beneficiary of this, can it be voluntary for the beneficiaries? Those are really key elements that we need to discuss, because this thing for Chama and let's Okota for everyone, it's giving Zimbabwe.
I mean, but we'll actually just have to wait for the court and hear what the court thinks about the housing levy. Maybe then we can come back and revisit
this in particular. Anyway, thank you very much for coming on studio and for this amazing conversation. I think between me and you, there are so many things we can talk about when it comes to tax. But for now, we'll call it a wrap. And until next time, it is goodbye from us here at the Debate Circle. Remember to check our social media handles for more of these conversations on YouTube, on Instagram, on LinkedIn, on Twitter, on TikTok, and on Threads, if we're still posting on Threads. Goodbye from us.